Welcome to PyUncut, where we break down the biggest stories in tech and markets into simple, powerful insights you can actually use. Today's story is about a sudden shock in the enterprise software world. Two of the biggest names in cloud software, ServiceNow and Salesforce, saw their stocks drop nearly 5% in a single session. And this wasn't because of bad earnings. In fact, both companies are still growing, still profitable, and still dominating their markets. So the real question is the market overreacting, or is this the beginning of something much bigger? Let's start by understanding what just happened. Both ServiceNow and Salesforce fell sharply, with ServiceNow trading near $106 and Salesforce around $182. This drop is part of a broader trend. Since the start of the year, both stocks are already down roughly 30%. And this isn't just about these two companies. The entire software sector has been under pressure in 2026. So what's driving this sell-off? The answer is one word: AI. But not just any AI. The fear is centered around something called agentic AI, or AI agents, that can perform tasks autonomously. These systems are evolving rapidly, and investors are beginning to ask a very uncomfortable question. What happens if software itself becomes less necessary? To understand this fear, we need to look at how companies like Salesforce and ServiceNow actually make money. Their business models are built on selling software licenses. Companies pay for seats, modules, and workflows. For example, a large enterprise might pay millions of dollars annually to manage customer relationships using Salesforce, or to automate workflows using ServiceNow. But now imagine a world where AI agents can handle those same tasks automatically. Instead of paying for a CRM system, what if an AI agent can manage customer interactions, update records, generate insights, and even automate sales processes? Suddenly, the traditional pricing model starts to look vulnerable. This is the core of the bear case. Investors are worried that AI could disrupt the entire software-as-a-service model, and that fear alone is enough to trigger a massive repricing of these stocks. But here's where things get interesting. While the market is pricing in disruption, the actual business performance of these companies tells a very different story. Take Salesforce, for example. The company reported around $41.5 billion in annual revenue, growing at about 10% year over year. That's not a company in decline. That's a company still expanding at scale. Even more interesting, its AI-driven products like Agentforce are growing rapidly, reaching billions in annual recurring revenue and showing triple-digit growth. ServiceNow is showing similar strength. The company reported quarterly revenue growth of over 20% and continues to guide for strong future performance. These are not weak fundamentals. These are strong, healthy businesses. So why is the market ignoring this? The answer lies in how markets think about the future. Stocks are not priced based on today's earnings. They are priced based on what investors believe those earnings will look like 5 or 10 years from now. Right now, the market is essentially saying this: even if these companies are doing well today, their future may not look the same if AI changes the rules of the game. And this fear isn't happening in isolation. There's a broader shift happening across the tech industry. Capital is rotating away from software companies and into areas like semiconductors and AI infrastructure. Investors are betting that the real winners of the AI era might be chip makers and infrastructure providers, not the software platforms themselves. We've seen this kind of shift before. Think back to the early 2000s during the internet boom. Many companies were profitable and growing. But when a new technology paradigm emerged, the market repriced entire sectors almost overnight. But here's the key insight. Disruption does not always mean destruction. Sometimes it means evolution. And this is where the bull case for ServiceNow and Salesforce comes in. These companies are not ignoring AI. They are actively building it into their platforms. In fact, their entire strategy is shifting toward becoming the backbone of enterprise AI. Think about it this way. AI agents don't operate in a vacuum. They need data, governance, workflows, and integration across systems. This is exactly what companies like ServiceNow and Salesforce already provide. ServiceNow, for example, manages workflows across entire organizations. If AI agents are going to automate tasks, they still need a system to track, audit, and coordinate those tasks. That system could very well be ServiceNow. Similarly, Salesforce is integrating AI directly into its CRM platform. Instead of replacing Salesforce, AI could make it more powerful by automating repetitive tasks, improving insights, and enhancing customer interactions. In fact, many of Salesforce's biggest deals now include its AI offerings. That suggests customers are not abandoning these platforms. They are expanding their use. So now we have two competing narratives. On one side, the market fears that AI will replace software. On the other side, companies argue that AI will actually increase demand for their platforms. This brings us to the real question. Is the market mispricing these stocks? To answer that, we need to look at valuation. After this sell-off, both ServiceNow and Salesforce are trading at significantly lower multiples than before. The software sector as a whole has seen major compression in price-to-earnings ratios. Historically, this kind of compression often signals either a major structural shift or a potential buying opportunity. And here's an important clue. Insiders and management teams are not acting like their businesses are in trouble. Salesforce has announced massive share buybacks, worth tens of billions of dollars. ServiceNow executives are also increasing their exposure to the stock. This is usually a sign of confidence. At the same time, Wall Street analysts still rate Salesforce as a moderate buy, with price targets significantly higher than current levels. So what does this mean for investors and listeners trying to make sense of all this? First, understand that we are in a transition phase. The market is trying to figure out how AI will reshape the software industry. During this phase, volatility is normal. Second, recognize that fear often moves faster than reality. The idea that AI will instantly replace enterprise software is still theoretical. In practice, large organizations move slowly, and they rely heavily on existing systems. Third, pay attention to execution. The companies that successfully integrate AI into their platforms will likely emerge stronger. Those that fail to adapt could struggle. And finally, think long-term. The current sell-off may reflect uncertainty, not necessarily permanent decline. To wrap this up, the drop in ServiceNow and Salesforce is not about weak earnings. It's about a fundamental question facing the entire tech industry. Will AI replace software, or will it enhance it? Right now, the market is leaning toward fear. But history shows that companies that adapt to technological shifts often come out even stronger. So is this a mispricing? It might be, but it could also be the market correctly anticipating a major transformation. Either way, one thing is clear. The AI revolution is no longer just about innovation. It's now about disruption, valuation, and the future of trillion-dollar industries. And for investors, this is exactly where the biggest opportunities and the biggest risks begin. This is PyUncut. Stay informed, stay curious, and I'll see you in the next one.